Okay, student, good morning. Today we are going to continue our discussion on Chapter 3, Financial Markets. We have 3 more markets for our discussion. The next market is equity market. All right. So equity security, also known as share or stock, represent ownership of a corporation. So stock is a paper, but now we don't use the paper anymore. We do all transaction online, right? Equity or stock or share are the most visible security in most modern economy. All right. So, I mean, you can find the information about stock market on TV news or newspaper, right? People talk about stock market, right? So I'm a finance lecturer on the campus. My GP, when he know I'm a finance lecturer on campus, and he can talk stock market with me. All right. So everyone pay attention to the stock market, right? Next slide. Primary equity market. So when I see the primary market, I know this the transaction between investor and company. All right, so company issue new share to investor. Investor provide money to the company. Right, this is a primary market. But in finance, we have a terminology for primary equity market. It's an IPO, initial public offering, right? It's an IPO market, right? So again, primary market, you can see company can receive the money from the IPO market. Now, next slide, secondary market, right? So when I see the secondary market, this is the image. Secondary market is a transaction between investor, buyer and the seller. So company will not receive the money from the secondary market, but company, they do consider the secondary market. All right. The idea is very simple. If their share price is no good in the secondary market, their price in the IPO market will be no good. Right. So this is our example. So when an investor buy 1,000 shares of ANZ Bank on the exchange, the proceed or the money will not go to the ANZ, right? But go to the investor, right? But it doesn't mean ANZ will not care about their share price in the secondary market. They do care, right? So almost all the secondary market equity trading is done on the exchange. For example, in New Zealand, we have New Zealand Stock Exchange. So when I see the exchange, I know it's a market press to bring all the investors, including buyer and the seller, together. So investor can easily sell or buy the share or the security in the market, right? And exchange can help the market efficiency. Please refer to our chapter 2, the market efficiency, right? So next slide, characteristic of equity market. So the function of secondary market is to provide liquidity at a fair price. So secondary market, exchange trading, we bring all investors to the exchange, right? Exchange market can provide liquidity. Liquidity is the ease with which asset may be converted into cash without a loss in value. So liquidity is easy to be converted into cash because exchange bring all the investors together. So investor can easily sell or buy the share in the market. And the exchange or the secondary market provide a fair price. So please refer to our chapter 2, market efficiency, right? So market efficiency is about fair price, right? The market efficiency will ensure return and the risk will go together. High risk, high return, low risk, low return. It's very important for finance, all right? So next slide, we discuss the equity trading. We have two types of order. It's not difficult to understand. So you can see market order is an order to buy or sell at the best price available at the time the order reach the market. So here is example. So if we can see the quote, bid $3.21, ask $3.22. So here I like to explain bid and ask. So in the market, you can always see two prices. One is bid price, the other one is ask price. So this is my way to remember. So when I buy the share in the market, I will see two prices. And if I buy the share, I need to pay a higher price. That is the ask price. When I sell the share, I will receive a lower price. That is a bid price. Right? We always have two prices. And the difference between ask and the bid is the spread. The spread is a profit to the dealer. Right? So you always can see two prices, right, in the market. Because to buy, we pay higher price. To sell, we receive a lower price. So if market order is here, you make a market order and the price quote is here. So you want to buy the share. Please know, when you buy the share, you pay the higher price, $3.22. So your order will be executed immediately at $3.22. The other order is limit order. It's order to buy or sell at the limit price stay on the order. For example, you make a limit order to buy a share at $3.22. If the market price keep going up to $3.23, $3.24, $3.25, your order will not be completed. Only when the market move back to $3.22. Right. So it's for me, I think it's easy to understand if we consider this example. Okay, so we have market order and limit order. Next slide. So we finished the equity market. We will have a chapter to discuss the equity market further. So before we go to next market, let me review some key concepts for this topic. Right. So equity market, for me, equity, stock, and the share, they are interchangeable in finance. All right. So sometimes I will mention stock market. Stock market is a share market, equity market. All right. And again, for equity market, we have primary market, IPO, initial public offering, versus a secondary market. Right. So on the newspaper or media, what you see, they are secondary market for stock, right? Like S&P 500, right? In the United States or New Zealand exchange, right? They are secondary market. Then secondary market is important, right? Exchange trading will bring all buyer and the seller together. It can ensure the market efficiency. Please refer to our chapter 2. We also discuss the type of order. We have market order and limit order. One more point. In chapter 9, we will have one chapter to discuss share valuation. Okay, next topic, derivative market, I like to spend more time to discuss this market. It's a very important market in finance, right? So derivative market, before we discuss the detail, first we discuss the benefit of derivative market. So derivative market provides significant benefit to financial market. Here we address the benefit. First, risk management. Second, increase liquidity by increasing turnover and the trading depth. Third, information. Right. So again, let me use my handwritten note to show you the idea of derivative market. Right. So for me, when I think about derivative security, I know it's a tool allow investor to buy the asset in the future. So here we address the spot market. S stands for spot. Spot for me is an immediate payment or delivery. All right. So in the spot market, you can buy the asset. Right. I use a T0 means per day. So here the asset, let's consider foreign currency. Right. For example, you are the business manager. Your company needs US dollar. So you can buy the US dollar in the spot market. S0 means spot price today. Right. So you can see the spot price, US dollar to New Zealand dollar. You can see the S0. But the question is, if you want to buy the asset, not today, future, or T days from now, if you want to buy the asset T days from now you have the problem. The spot price ST, T days from now, is a unknown variable. We don't know ST, right? We don't know the price T days from now. Therefore, in finance, we have derivative security. In particular, we have forward and the future. Later on, we will give you the detailed definition, forward and the future. And the option. In the option, we have the strike price, K. They are a predetermined price, right? That means we can determine future and the forward price today and do the delivery T days from now, right? So you can see the benefit of the derivative market, because one, future and the forward price or strike price, they are a predetermined price. So first benefit is risk. We can control the risk or manage the risk using the derivative security. Second, information. We can use the future or forward price to predict ST. ST is an unknown variable, but we can use the forward and the future price to predict the ST. All right. And because of risk management, we can control the risk. We can attract more investors to the market. Therefore, the derivative security can increase the liquidity, right? So increasing the turnover. All right. So for me, so far, you just remember derivative security is a tool to allow the investor to buy the asset or sell the asset in the future at a predetermined price. All right. And you can see the benefit, risk management, and the information. Right. Next slide, we discuss the derivative market further. So here we show you three types of derivative contract: forward, future, and option. Right. So we will discuss them in more detail later. So derivative security, when I see the derivative, that means not original, right? So derivative security is a financial instrument whose value depends on or is derived from the underlying security. All right. So in finance, we have three key financial assets: stock, bond, and the foreign currency. All right. So we have spot market. Spot market means immediate payment and the delivery. All right. If you want to buy the asset, not today, in the future, 3 days from now, in the finance, we have derivative market. All right. Of course, the derivative security, its value will depend on the underlying security. All right. And again, when you see the price, you will see S price and the bid price. Right? S, higher price. When I buy, I pay the higher price, S price. Right? When I sell, I receive a lower price, the bid price. All right. Okay, now we'd like to discuss the differences between forward, future, and the option. First, you need to remember they allow investor to buy or sell the asset or underlying asset in the future at a predetermined price. So next slide. So we discussed the differences between future and forward. So forward contracts are traded in informal OTC market. This is not a standardized contract, right? Not standardized in quantity, delivery period, and the grade. Grade means quality, all right? The quality of the deliverable item. So again, let me use my handwritten note to show you. When I see the OTC market over to counter, OTC market, that is buyer and the seller, they will make a deal directly. Right? Forward contract is an OTC market, so it's a non-standardized contract. Right? It's non-standardized is good, you know. You can have what you want, right? But you can see the problem is the default risk. So you can see the buyer and the seller, one party might default. That means they will not keep their promise. The idea is simple. Think about the trading. These are zero-sum gain. One party's gain will be the loss of the other party, right? So buyer and the seller, one of them might default, right? Or you can say not keep their promise. Because of the problem, we have the futures contract. So futures contract are traded on an organized exchange. So when I see the exchange, I know exchange will bring many buyer and many seller together. So we have exchange between buyer and the seller, right? And the future contract are standardized contract in quantity and the delivery period, as well as the grade, or you can say the quality of the delivery item. So it's a standardized contract, right? Because it's a standardized contract, investor can close out their position before maturity. So if you have the future contract, you can buy or sell the asset, not today, 3 days from now, right? And you don't want the position anymore, you can close out your position. That means sell your position in the market, right? Before the maturity. The reason, these are standardized contract, all right? So I give you an example like this, all right? Let's consider the asset is a US dollar. You want to buy US dollar 3 months from now, but US dollar's value is not a constant. You want to control the risk. So you can use the US dollar forward, or you can use US dollar future, right? The difference between forward and the future is forward contract is a non-standardized contract. Future contract is a standardized contract. All right, if you don't want the US futures anymore, you can close out your position in the market. Right. Next slide, we discuss option. It's a very important innovation in finance. So option, we have call option and put option. Call option is option to buy an asset by a certain day for a certain price or strike price, right? Put option is an option to sell the certain asset by a certain day for a certain price. So call is an option to buy. Put is an option to sell, all right? So here we'd like to highlight the key differences between option and future or forward. Holder of option is not compelled to buy or sell and will not do so unless the trade is in the money, right? That means option is a choice. If your option is out of money or the option cannot bring you positive cash flow, you can decide not to exercise the option, all right? On the other hand, future and the forward contract, they are obligation, right? So even you are losing the money because of future and forward, you have to keep your promise, right? So you can see the differences between the option and the future and forward. So let me give you the example again. So this is our previous example. You want to buy the US dollar 3 months from now. You can use US dollar forward, US dollar future, or US dollar option, right? So if you use US dollar option and the option will not give you the positive payoff, right? That means it's out of money. You can give up the option, all right? On the other hand, forward and the future, your loss will be realized. So option, forward, and the future, they are very important issue in finance. We will have more detailed discussion in our Finance 302, right? You are welcome to study more by enrolling our Finance 302. Before I finish this topic, when I think about option versus obligation, I'm thinking a joke. The joke is about marriage. Before marriage, this is an option. All right? If the relation is not favorable to me, I can decide not to exercise, right? No penalty. So option is good. But after marriage, the relation will become an obligation, right? If I don't keep my promise, my wife will sue me, right? So this is an obligation, right? And I cannot close out my position early because it's non-standardized contract. It's very difficult to sell my position to other people, right? Okay, I hope now you understand the difference between option and obligation. All right, next slide, we like to show you some terminology of option. So one, strike price or exercise price is a predetermined price, right? So option holder, they can buy or sell the asset at the predetermined price in the future, all right? Option premium. So you can see option is variable. So to have the option, you have to pay premium, option premium. So option premium is an option price, the price of the option, right? So the option buyer will pay option premium to option seller, right? So option buyer, they have the right. They need to pay the premium to have the right. So option seller, they receive the option premium. Right? And the option, we have American option and the European option. American option is option can be exercised at any time before and including the maturity date or expiry date. Right? European option the option can be exercised only on the expiration day or maturity day. Right. So again, I use the image to show you the difference between European option and the American option. So European option, the option can be exercised on the maturity day only. Let's say our maturity day T days from now. All right. American option, the option can be exercised any day before the maturity day. So you can see American option value will be higher than European option value, right? Because American option has more choices, right? Option holder can exercise their American option any day before the maturity day. All right, so we finished the discussion on the derivative market. It's a very important market in finance. So here we review some key concepts for you. So derivative market include forward market, future market, and option market. Right. The point is you have to understand differences and the similarity of them. Similarity of them will allow the investor, they are a tool to buy or sell the asset in the future at a predetermined price. Similarity. Right. Now we address differences between them. Forward versus future. Forward, non-standardized contract. Future, standardized contract. Forward, OTC trading. Future, exchange trading. Right. When I see the OTC, I know buyer and the seller, they make a transaction directly. Exchange, we have exchange between buyer and the seller. Right. Exchange can help default risk. Because of exchange trading, default risk will be lower. Next, forward versus future. Right. Forward, non-standardized contract. So it is unable to be closed out before maturity. Future contract is a standardized contract. It's able to be closed out before the maturity. Right. Next, option. So option is a choice, not an obligation. And option, we have call option and the put option. Call is an option to buy. Put is an option to sell. And option, we have American option and the European option. And I know American option value is higher than European option value. All right, finally, of course, here, 101, we just give you an introduction to the derivative market. In Finance 302, we have more detailed discussion. You can use the option to develop different trading strategy. And we also will discuss the variation of the option, right? Or the value of option. But it's very important because option has a value, right? So we have the issue of option variation. Okay, we have final market, foreign exchange market. So foreign exchange market are firms that conduct business in foreign country with different currency will face two additional risks. One, currency risk or exchange rate risk. The value of currency are fluctuating relative to each other. Second, country risk or political risk, loss due to political action in the foreign country. All right. So I think it's not difficult to understand. So think about you are the business manager and your business has activity or business activity in a foreign country. Then you will face currency risk. For example, you have a business in China or in the United States. Your payoff, your revenue will change because of exchange rate risk, right? And you might also face the political risk, right? The government, their policy might change, and it will cause loss to your company, right? So we have two additional risks for the international business. So next slide. Difficulty of international trade or international business, right? So you can see the first challenge or first difficult is foreign currency, right? The value of foreign currency might change. And second, no single country had total authority over all aspects of this transaction, right? So when I think about that, it's a political risk, right, or country risk, and different countries have different legal tradition, right? So I think it's not difficult to realize this difficult, but we don't need to understand the detail. We just know the concept. So in New Zealand or in China, they have different legal condition or requirement, right? And finally, is information, right? So information is another problem, right, in different countries. Okay, next slide. Two distinct international market. To facilitate this international transaction, there are two kinds of international market. One is international money and capital market. All right. So here, when I see the money market, I know it's short term. For example, short term bond, right? Short term, lower than 1 year. Capital market, long term. For example, long term bond. Right? Now we consider international bond. Right? So international bond, we have two types of international bond. Foreign bond, right? Foreign bond and euro bond. When I say foreign, mean the bond is issued by a foreign company, foreign bond. Euro bond, when I see the euro outside the home country. So euro bond is the bond issued offshore. I mean, outside the home country, right? So like our money market and the capital market, now we have international money market and capital market. Right? And when we do the business in a foreign country, we have the exchange rate risk, and we have the foreign exchange market or FX market. It's an exchange, it's a media of exchange of the means of payment. So when I see the exchange, I'm thinking exchange rate between a foreign currency and a local currency, like a US dollar to New Zealand dollar. So next slide, the operation of foreign exchange market. So we are going to discuss three exchange rate system. So we have fixed exchange rate system, floating exchange rate, and managed float. Right. For me, it's not difficult to understand. We know the exchange rate, for example, US dollar to New Zealand dollar is not a constant. It will change over time. And our reserve bank, right, or the central bank will have three systems. One is a fixed exchange rate, floating exchange rate, and the managed float. So for me, it's like this, right? So you can see the exchange rate is not a constant, will change over time, right? So fixed exchange rate, that means the reserve bank will fix or control the exchange rate like a constant, fixed exchange rate. All right. In New Zealand, the Reserve Bank, like the market to determine the price. So we use a floating exchange rate. Floating exchange rate, that means the exchange rate is decided by the market. Right. So you can see our New Zealand dollar is valued to US dollar change floating. Right. It's decided by the market. Managed float. So the idea is simple. Managed float means the Reserve Bank might have like an upper bound and a lower bound, right? Within the upper bound and the lower bound, the Reserve Bank will let the market decide the exchange rate. So exchange rate will change within the range. But over the boundary, the Reserve Bank will intervene. That means they might manage the exchange rate. All right, they can either buy or sell the foreign currency to affect the exchange rate. We will have one chapter to discuss Reserve Bank in chapter 4. Right, chapter 4 we will discuss Reserve Bank. Okay, next slide. Globalization of financial market. Right, so our market is more globalized, right? And we have some factor that can promote the globalization or internalization. I think for me, they are not difficult to understand, right? One is deregulation, right? And the second, standardization. Third, integration and IT. Right? So you can see this factor can help our market will, more close, right? So like a deregulation. But you can see, but now the trend seems to be changed by one person. Our U.S. President Donald Trump. He doesn't like globalization, but before him, you can see the trend, globalization, right? But now could be another story, right? But for me, this concept could be easy to understand, so we don't need to understand the detail, but you can see the trend, the trend of globalization. Okay, we finished the chapter. Again, before we finish the topic, I review some key concepts for you for foreign exchange market. First, I know in finance, we have three major financial assets: share, bond, foreign currency. So exchange rate market, foreign exchange market is about foreign currency. So when we conduct business in a foreign country, we will have two additional risks. One, exchange rate risk. Second, political risk. Although we have two additional risks, the business in foreign country, they might have more opportunity. For example, finance, how the money is raised. Right? If you have business in a foreign country, you might have more opportunity to raise your money. Not only raise your money in home country, but also from the foreign country, right? And how the money is used. When you invest your money in a project, you can have your project in a foreign country, all right? So you have more opportunity, right? However, you will face additional risk, exchange rate risk and the political risk. Then I know the difficulty of international trade or international business, right? Like a risk, information, and the legal condition. Finally, we discussed the three exchange rate system: fixed, floating, and managed float. Right. Okay, we finished this chapter. Before we go, let's recall our attendance. Give me a minute, I show you the QR code. Okay, student, now you can use the QR code to record your attendance. Online student, I hope you can see the QR code from your end. Thank you for coming, and it's a sunny day again. Enjoy your weekend. See you next Friday.